Good morning, everybody. Welcome to the Flow Show. Another fun-packed show we've got coming up for you today. Morning, Kay. Morning, Stel. How you doing, lads?
Good morning, everybody. Good morning, Ryan. Morning, Stel.
Morning, mate. Are you there, Stel? Are you there, Stel? Nope, he's here in spirit.
Yeah.
Maybe some problems with his new laptop.
He's got a little issue with his microphone, it seems.
Yeah. Okay, well, hopefully he'll pop up in a moment. In the meanwhile, let's get stuck into
Can you
stuff.
hear me now? Hello, hello.
Ah, here he is. Here he is.
Hello. Hi, sorry about that.
That's
New
all right,
equipment. So, do you guys think we should be adjusting this show for inflation, making it a little bit longer?
I think it's quite long enough for the viewers what they get here for nothing. So right. Yeah, no, we shan't. In a word, big fat no. Obviously, we'll get into the inflation story in a while. China is expected to see further rate cuts, including RRR cuts this year, according to Chinese press, citing analysts. So a bit of a heads up coming from that. China's Ministry of Finance are already starting with their tinkering to help the economy. They're going to cut purchase tax by half for new electrical vehicles. That'd be vehicles bought between 2026 and 2027. There are other tax incentives for NEVs coming in, purchasing from now for the next couple of years, but they will cut their purchase tax by half for future purchases of that. We're going to hear a lot more along those lines, different tax cuts and stimulus measures over the next few weeks, no doubt. Bank of Japan had its minutes out, and most members, nearly all members, said it's important to continue with monetary easing. A few of them said that they must support wage momentum with easing. One member said wage gains are needed for a sustainable inflation goal. One member said 2% goal coming into sight, but there's risks for both sides. Another member said there's signs of a virtuous cycle between prices, wages, and that had started to be observed. Another said we should avoid abrupt changes in rates. And another said that central bank should consider revising its conduct of YCC, but it was appropriate to wait and see a little longer in light of the situation in global financial markets. So overall, there's always, as we know, hawks and doves on a board, and there's a couple of, well, you could describe them as hawkish in comparative terms. So a couple of them thinking that maybe inflation is on its way and maybe a bit more stickier than what we're being told, but overall all want to take a cautious approach to it. We did get Bank of Japan's Adachi coming out after that saying it's too early to tweak easy monetary policy. Inflation is faster than I expected, sees both upside and downside risks to the price outlook. And the longer run downside risks appear to be bigger. It's appropriate to continue easing with yield curve control. There's a low chance of tweaking YCC in July if bond market function remains in its current state. Later on this morning, Governor Ueda said that Japan's economy is picking up and that corporate earnings are at a high level and capex is recovering. Any thoughts on the BOJ stuff, Kay? Anything of note that we should be picking out of that lot?
Yeah, I think it shows again what we've been saying for a while. There should be and there will be discussions, and now they are starting to say something, but it's like one member here, one member there. And Ueda, it's always interesting because it seems that his communication, and I'm not going to front run events, but it seems that his communication is very, very, very slowly but evolving. That's what I found out. If he says that capex is doing better, the economy is picking up is the line that Kuroda used for the past 6 or 7 years, I think. So I wouldn't read too much in there. But the capex thing should be positive. The market is not trading it yet because there's such a big differential in interest rates. And if we look at what's happened on the 10-year JGB as well overnight, it's actually coming off from Monday. It's been gradually coming off. Yeah, I missed yesterday, but we are well below the 0.4% mark now on the 10-year JGB. So the market is pricing a lot of it out, and we may, but I think we may slowly being on the last legs, I think, for the repricing. July will probably not give too much, but I sense this very little very small evolution in the rhetoric now.
Yeah, we've been monitoring that for quite some time. Obviously, you know, we had the change of language from Ueda. Instead of persistent easing, it's patient easing. Maybe we should call it snailonomics, where they slowly like a snail creep towards the end of easing. It's certainly not going to be as fast as what we've seen in the other major economies.
Yeah, that's a pretty good name, actually, snailonomics. That's probably what is going to be, right, in the end. But we sense a little change gradually, okay? But again, I mean, if they don't do anything in July, then yen, I don't know for how long it can benefit from it. But we'll have a look at the rates later. But I'm starting to find this 142 a bit of a tough nut in dollar yen.
Yeah, it's definitely showing up a bit of resistance. We had a little look above again this morning, but couldn't quite get to that prior high. And that might be a bit of a signal. But, you know, you never know with this pair. It did similar, you know, back late May, got to a high, just got up to that same high. Then you thought it might be coming off a bit, and then sideways and wallop, off we go again. So maybe we get a bit of a range developing again like we did there. When we were at 141s, couldn't get through there, back down to 138.5s, 139s. Maybe we get a similar move here. So from 142s, we have a look at 140s and then decide what we want to do. But yeah, we'll look at that in more detail shortly. Going over to the ECB, I'm going to save the best for last with the UK. ECB's Wojcik said core inflation pressures remain in the Eurozone. Sometimes a soft landing is not possible. We have to consider the risks of doing too much versus too little. ECB Simkus said he would not be surprised if we raised rates in September, and he would be open to discussing if we could do more with APP than stopping reinvestment. ECB's Phil Roy doing a victory lap again, saying inflation is past its peak in France and the Euro area, and that the duration of the terminal rate is more important than the level. The peak of wage increases should be reached in the second half of the year in France. France is also going through a similar theme as to the UK, with lots of strikes over pay conditions and that sort of thing. And they could well be getting hit with a wage pressure inflationary bout over there. They also join the list of new government forecasts or bank forecasts. They raised GDP for 2023 by a pip to 0.7%, not as much as we saw in Spain and Italy, but they did cut growth for 2024 and 2025. Looking over at some of the data from yesterday. Oh, where's my button? There we go. US data. We had some housing data coming out and pretty strong numbers in the end. Building permits up 1.491 million, beating the expected 1.425, and a big jump over last month. Starts as well, a nice big gain, 1.631 million versus 1.4 expected. This was something that Powell brought up at the FOMC, saying he thought that the housing market had perhaps bottomed. On top of the NAHB number, which jumped on Monday, I think it was, He might be right about that, but we know there's two sides to the tale in terms of US housing market, the affordability side and the inventory side. So further housing data this week as well. We'll keep an eye on some of the price metrics within those. Not on the calendars still is the Philly Fed Services Index. That came in a little softer, minus 16.6 versus minus 16 previously. In the components, new orders stacked it. They fell 16.2% versus 2.7 in May. Employment stacked it as well. That fell 14.3 versus a positive 14.9 last month. The wages and benefit cost index also slipped. It was 22.2 versus 35.3 prior. So negative numbers there for services, employment and new orders, and a fall in the rate of growth of wages and benefits. This is for the services sector, which has been the stalwart really of a lot of economies. It's only a regional number, being just the Philly number, but something that we might be on watch for when we extrapolate it over to things like the PMIs, the first of which we get on Friday. So we'll keep an eye on those flash numbers. As far as the Fed heads are concerned, Fed's Cook said that elevated inflation is a grave threat to the US economy, and that they're focused on inflation until the job is done. And potential newbie Kugler, if I pronounce his name right, says they're deeply committed to reducing inflation. There was a few more comments out from Secretary of State Blinken on the China stuff, saying both the US and China agreed on the need to stabilize the relationship, but he also threw up a load of, let's call them backwards steps comments about what China's been up to and how the US are not going to stand for it and that sort of thing. So one step forward, two steps back from his comments. The Chinese ambassador to the UK drew some lines saying that de-risking from China is no different to decoupling. A lot's been made of countries saying that they are decoupling or they're de-risking from China, and that's not the same as decoupling. Well, China says it is. So as I say, they're painting a red line on that. So to the main course so far today, and three guesses who's not surprised that inflation was sticky, if not horrendous, in the UK. Headline CPI came in unchanged, 8.7%, was expected to drop 3 pips. Core inflation rose 3 pips, was expected unchanged to 7.1%. Colour me surprised. Some of the other numbers, not you could say that bit of a saving grace, but very minutely. PPI numbers came in, and the rate of growth is falling there, though we're not seeing some big wholesale negative numbers year on year. Output year on year down to 2.9%, which was lower than expected and less than last month. Input prices came in at 0.5%, so lower than expected, the 1.2 there. So softening of the rate of PPI inflation there, but no negative numbers, as I say, like we're seeing elsewhere. Just one other thing as well, aside from the CPI numbers, which has taken all the attention, there was some borrowing data out from the UK as well. And on that front, UK government debt has surpassed GDP for the first time in 62 years. A lot of this was due to borrowing for energy support schemes, benefits and other stuff that could be classed as temporary measures. But the papers and the press making a big hoo-ha about that. That's a negative for the UK. Obviously, increased debt to GDP is something that the Chancellor wants to keep down and get down, but unfortunately he's had to wear a move above 100% of GDP for now. That's going to weigh on things like sentiment for the UK. But the big numbers was the CPI data. And as we've been talking about this week, it presents a real big problem for the Bank of England tomorrow. So far, the market is pricing in now a 6% BOE peak by December. That was previously looking at February for that. Some traders now see a 50% chance of a 50 basis point hike tomorrow. The rate probabilities still side with a 25 at about 62%, with a 50 basis point at 38% on the other side there. This is all coming amidst this mortgage mess that I was speaking about yesterday on the show. So the BOE is really between a much rockier and harder place than they were yesterday. They face mortgage rates going up, which are driven in parts by rate increases. That's going to put a squeeze on mortgage holders and lead to a potential crisis for consumers and the housing market. And they're faced with high inflation, which, according to the rule of thumb, hiking rates is supposed to cure. So they're in a bit of a spot of bother, as we said. Do they hike big to contain inflation and screw over more mortgage holders, or do they go a smaller hike, which will be less pain for mortgage holders, but might not do enough for inflation? Who'd be a central banker? Kay, Stel, do you fancy the job?
It's a rock and a hard place, mate. I mean, seriously, these inflation numbers warrant more hikes. No question about it. Even though PPI input PPI input really is dropping fast. Even though that's the case, headline and core, even worse, is rising. So theoretically, the Bank of England should keep hiking. The question is, though, with the mortgages where they are, with the disposable income vanishing, at a very rapid pace everywhere in the world, but probably in the UK more than other Western economies. What do you do as a central bank? I mean, you should be hiking, but if you hike more, you're just going to completely suffocate the economy and take out whatever energy still has left. So I really don't know what I would do here. I really don't. It's
okay, Kay, what would you do here?
Me? Well, they have to hike, right? There's no other way. But then, and that is, I think, what we see as a reaction in the market. It's not because your CPI is going up that your currency necessarily has to go up. And I guess I'm not the first one, but there's this feeling of stagflation starting to build. And me included, after seeing those numbers. We have to be very careful now what's going to happen with other data in sterling, because if we see some sort of small deceleration of negative numbers creeping in, the sterling could get hit hard. We'll see what happens tomorrow on the Bank of England. But yeah, they have to hike. There's even decent pricing of a 50 BPs in there. Really the risk is that they just have to go, right?
Yeah. I mean, I think the rate probability pricing 62% for a 25 and 38 for a 50. I think that's probably about right. They could surprise with a 50 tomorrow. I don't know how they'll sell that.
Badly.
And like you say, the reaction in the pound could be the opposite effect. It might feel like a panic move more than a calming move if they go a 50. Sorry, yeah, you were going to say something?
Yeah, how they will react and how they will sell it, it's probably going to be badly as usual.
One thing I've said before, and I think they might have a go at this explanation for not hiking as much as really they should, is they can say, look, it's a choice. We can either have to endure a little bit higher inflation for just a little bit longer, and they're going to assume and project that this is going to go down eventually, maybe 6 months from now. Or, but we keep, people keep their jobs. It's going to be a question of whether you pick inflation over jobs, because we know that if they keep tightening more and more, there's going to be more job losses. The economy is going to go into a recession. It's without doubt. So they can argue that, look, we are willing to sacrifice a little bit higher inflation for a little bit longer to keep more jobs. And if you're the average person in the UK and you're like, well, what do I prefer? To have a little bit higher prices for a little bit longer for the goods that I buy, so which means that I'm going to have to prioritize over my spending, or do I and keep my job, or do I, potentially have the prices falling quicker, but then I don't have a job? It's
Yeah.
is my disposable income going down, or do I not have any income at all? So
Yeah.
they could push it this way, and I think that's a very powerful argument for anyone to say, yeah, okay, let's deal with higher inflation for a little bit longer in the hope that it comes down magically some way.
Yeah, but and on the flip side, I would say we are very close, if we're not already in a wage spiral, which is something other governments and central banks have been wary of. Because if your mortgage price is going up, if you see in the news that train drivers are getting 9, 10, 25%, NHS workers want 35%, all these sort of things, you're going to go into your boss and kick the door down for a pay rise. And if it's granted, it just feeds more inflation. You're nullifying the increasing costs of things like mortgages, but you're fueling inflation, which is going to put rates up and increase the cost of mortgages. So the UK is very in danger of becoming in a higher price spiral, the way this is going. And that's, I think, the big fear for the Bank of England. How do they nip that in the bud in a way that they haven't done so far? Because there's still plenty of inflation to come in the pipe. There's going to be some relief. Energy bills will be dropping from July. I know that because I've had my email through from my energy supplier, and so that will probably come through into the numbers maybe into August, but that's still 2 months away. But that's going to impact things, and we should see a decent dip in inflation, but that's countered by the domestic stuff that's still in the pipe: wages, food, that sort of stuff. So it is a rock and a hard place for these guys. I have no sympathy for them. Just to answer, RA's asking about the difference between RPI and all the others. Well, RPI is obviously the retail side of inflation, so it's shops and that sort of thing. And we know things like grocery inflation has remained robust. As you can see there, year-on-year RPI still running at high levels, 11%, and even the core RPI number there still running hot as well. But that all there's, like a lot of central banks, there's a lot of or a lot of countries, there's a lot of different inflation measures. There's a CPIH measure, which is the amount of inflation when you strip out housing and that sort of thing, which is actually the preferred method for the Bank of England, the CPIH. But even that, I'll just check it now, even that I think was higher. Let's see if it's got it on here. CPIH.
Ryan.
Yeah.
Can I just say something in answer to that question from RA? I mean, the core RPI, excludes mortgage payments. The core CPI excludes food and energy. That is the difference. If I read your question right, so it's a different measure.
Yeah, exactly. And all in all, they're all still higher. So what's happened in the pound? So the pound has seen a bit of weakness. I'll look at euro sterling because that's the one I'm in. So we can see a bit of a bounce there. It was floating and lower into the data, and I managed to finally take some money off the table down in the 30s just as the data was trickling out. Glad I did that now. So why has there been a big reverse in the quid, as apparently we're pricing 6% rates now and potential of the Bank of England going a 50 maybe tomorrow? The main reason is that a lot of this prior move down has been in big part to repricing of the Bank of England. That's not a surprise because we've been talking about it on here for months. Certainly I've been talking about how the Bank of England will be forced to hike rates higher than expected. So, we can say probably from the end of April, even just this last leg, is the market pricing the Bank of England going higher. Now, the difference that they've priced is maybe getting to 4.5% to now going to 5.5%, 6%. So it's not, you're not going to see 500 pip difference moves here on that repricing. And the market has got down to a level. We were pricing 5.7%, some were pricing 6% well before the CPI. So the market is round about its pricing level for where it thinks the Bank of England's to go. If we have to reprice again, then we'll likely get another move. So for now, we've got that on one side, that we've perhaps priced as much as we're going to price rate going to 5.25%, 3/4, 6% or whatever. On the flip side, we've had the ECB just come out and reaffirm their hawkish stance that they're going to keep hiking. There's maybe another 2 at least in the pipe. That's another reason why this is not going down. At least it doesn't mean it's going to shoot higher, because it didn't after the ECB. We couldn't even get through 86 properly. But also, as I was saying yesterday, this mortgage stuff, this, called it the cost of living crisis or whatever in the UK, is becoming a issue, and it's an issue that's not positive for the pound. So for me, looking at the quid on any measure you like, against cable, whatever, we've got 2 opposing forces at the moment. There's reasons why the pound should be more bullish, because we've got higher inflation that's not going away. We've got the Bank of England forced to hike higher. But on the other side, we've got this negativity from what's happening in the UK with this mortgage stuff. So I'm a bit finely balanced. I'm a bit neutral on the direction from here. I think we could get a confirmation move higher in the quid if they go a big 50, and maybe if they go a 25, but indicate they're going to have to take rates much higher. I think that might be a confirmation move the market will look for. After that, though, I certainly wouldn't be overly keen on keeping longs for any length of time, because if they go a 50, I think an initial pop might get sold into, because it would be seen as a panic move. Now, I say that even as I'm long the pound, so I'm going to be watching the BOE very carefully. If I decide to get out my euro sterling shorts somewhere down below, if given opportunity, I might smash the button on that one and then move to the sidelines. What do you guys think about the quid? When it comes to pricing, it's always a difficult thing to factor into prices, isn't it? But you know, the Fed's on stop. The Bank of England's going to keep hiking. Is there still some upside in the quid, or would it be a last hurrah if we get one?
I personally think that on policy divergence, mainly, we're going to have the pound outperforming. I don't think it's going to be going stellar, but I think it's going to continue to outperform. I've said it for a while, especially on the euro pound, which is a lot cleaner in my opinion. You know, below 87.2, I think it's bearish, and I think the target. Okay, we're going up today, but I think the target's in the low 83s. Having said that, the picture for the UK, as you very well described, doesn't look rosy for the economy, for the potential, you know, second round effects of inflation and, you know, mortgages, everything. It's just not good. But I think for the short term, and by short term, I mean for the next few months, I think the central bank policy divergence, because I think they will have to keep hiking in the UK. It's probably going to push the pound a little bit further. So 83 and a half, I think in euro pound is probably going to be terminal. And cable is a little bit more tricky for me. But I am a dollar bear anyway. So I think, you know, 130 is not out of the question before we need to make another decision on where we go from there. So to answer your question, I think the pound probably outperforms for a little bit more, and then the poop hits the fan and we reverse. That's what I think.
It's the fan. Love that one. Yeah, I think if we see 130, I might have my hammer out on that one. Kay, what are your thoughts on the quid?
As people in the room know, I've let my long sterling go on after the number, and the market seems to have me included waited for this number as well. We probably have the confirmation that 25 or perhaps even a 50 is in the pipe now, but your move is there, and I'm not sure whether this move will have a lot more legs. I'd argue it's especially euro sterling that really pushed sterling lower today, but then it took all the rest with it. Cable is a bit of a victim, you know, of the whole thing. But we have to note that we had a couple of attempts above 128 and they failed. I don't know why specifically 128, honestly. But I would have seen it perhaps closer to 130 as well. And we should have had this move today on the CPI, but we didn't. So relatively happy to go neutral for now. And I'm very curious to see what the move will be tomorrow on a 25 and on a 50. But I'm afraid that whatever they do, there may be enough just people wanting to either get out of their longs in the sterling or just plainly sell it if they do a 50 on a panic move, as you say. So yeah, for the time being, neutral and watching the game, having a beer.
Yeah, and Mike asked a question: what about foreigners picking up gilts for a carry? Well, I think the carry trade has been pretty evident in something like Guppy, and again that couldn't take on the highs that close. So we've still got this 182 level. So it's looking a bit similar to a lot of other pairs like dollar yen and whatever. And if we can't get through that 182, then you've got to think that perhaps there's some downside to come from that one. But a lot of people are making a big song and dance about, government borrowing costs are higher because yields are going up and so on and so forth. But what people are forgetting is that real rates are still well in negative. So while the government may be paying more to service debt and whatnot, add inflation into the mix and it's still a negative number. So the debt is being inflated away, as you will. It's obviously that's not a solution to anything. But if you compare it to other countries, in the Eurozone who may be paying, 3% on their 5 years bonds or whatever, and they've also got a high inflation rate, but they've got a higher interest rate as well. So the gap is closed between negative yields and positive yields, and that's something that needs to be factored in. So if you get into UK yields, you got to remember that with high inflation, a lot of that you're losing out on if you're sitting on it for a while. All part and parcel with what goes on in terms of when you're talking about financing stuff. Right, going to have a little look around and let us know if you're looking at the quid and what you're doing for the Bank of England tomorrow while we talk on about other prices, and we can come back and talk about what you guys and girls are doing in the chat there. Just looking around, I'll let Kay take a few pairs as well, but a couple of key ones I'm looking at. Dollar China, that's managed to break the prior high, which is encouraging, and give or take a few ones. We're holding that break. We're holding the prior high that didn't quite get as high as the previous high, but by and large, we're trying to hold above this break point. If we do, that should give it a bit of a springboard. Maybe we get a proper move up into the 121s. Still green lights from officials over there. The FIX was up at 7.18, give or take. That was up from 7.16 yesterday. So the fixes are still following and no signs of the brakes being applied there. The main support level probably now is down around here, 1670. That's a bit of a step up from what we've seen down below around the 14s, 15s, and from the 11s and 12s. So those are the two levels now, right up here and right in there at 1670, the support points I'm going to be looking at. If we hold those on a dip, keeps the trend in play, I'm happy to remain long. I want to see a sustained move above 720. If I get that, I'll start reeling in the stops behind from this entries down into the 711s. I'll start putting my stops up above that level, get them into profit or at least close to break even for that one. Kay, do you want to have a little whirl around since you're off yesterday? You can give us some fresh eyes.
Yeah. I'm going to have to do it relatively quickly because I have an appointment outside. But let's do. I know you showed already the euro sterling, but I just want to point you to this one I'm watching here, and it's this little trend line that had been forming of the highs. And well, I don't know why this thing. I had a little issue with my charts overnight. It seems that some of them have been. I don't know what's been done in TradingView or so, but some of them are not really looking like they should. So this one here, 85.65 was the first level I was watching on the top side. I did cut mine around here 45. The other day on Monday or so, I cut some at 27 of my shorts, and I went out of the sterling today because I think well, for me at least, I saw what I needed to see, and for the time being, I'm going neutral. So keep an eye on 85.70 up above or below 65.70 today. I'd say if we manage to get back down. But I also think that when we look at other euro crosses, there's a lot of euro being bought this morning, besides the sterling being sold. On the cable, as I said, I don't really know why we stopped there, right at 128. I don't really see much on the charts over there. But what I would say, though, is start keeping an eye on what's happening around 126.80, and then much more importantly, if you would get back down to the 126s, for this move to hold, we should either keep the 126.80 or 126 the figure. If that holds, then we can start to form another leg in the cable. But I'm neutral there right now. I also want to have a look at first of all, metals. They're not feeling great right now. If you look at silver on the what's happening with my charts? I've lost. What's happening there? I've really lost a lot of my stuff here. Sorry about that, guys. Looks like, but anyway, I had a trend line there. I don't know whether it's over here. It's not the right one. Oh, over here. And I don't know why it disappeared. So that's around 23.20, and we are below now. So that could bring us possibly back to this this prior low 22.60s, or even the low 22s. Metals really got hit yesterday when I was off. I don't know exactly why they got hit so much or so hard. But anyway, it's looking a lot less sexy than when it was up above 24. I'm patiently waiting with my silver bits lowered down. Gold, similar. We're hanging back on those prior lows. I think it's possible to go and visit low 19s, 1900 perhaps, if this move is to continue. We are starting to reject the shorter term trend lines up here, so looking a little bit weak in my opinion. Yen, there's stuff going on in the 142s. Okay, we have this prior high here, 142.25-ish. We have this spiky before we continue to go lower here. We have the 61.8 of the whole move lower from 150, close to 152, back down to 127. And we have a bit of an extension here of this setback also coming in around 142.5. So that's what I mean by saying there is stuff going on here. We're also hanging around this this wedge or channel, or whatever you may call it, trend line. So anywhere between 140, 180, 142.5. I think there's going to be important enough monitoring to see if we really can go. If it clears this 142.5, then I think we're talking about the famous 145, where most of the market is expecting MOF to come into play. But we'll see about that if we get up there. But in the meantime, this 142, 142.5 is already important enough for me. So I'm still long via my call that I bought last week before the Bank of Japan. I've hedged quite a bit of it, so I've got about a smaller third running. If it breaks, then I'm going to try to keep it for the whole move. Sorry, up to 145. But I think I may make a decision on that one today if we don't manage to clear this 142 zone. That for the dollar yen. Euro yen is also turning around interesting levels, extension, and this trend line here coming in around 155, 10, 20. And we're struggling a little bit. So we're struggling on a few of those yen pairs. Also, if you look at, and then we have to get back to the sterling yen. Sterling yen went into this, well, this is the 180.5, and we're already trying to get back below. But we went into this extension here, 182.40, and we stopped just shy of it. So that's another yen pair that is starting to show signs of perhaps exhaustion. Has to do with the sterling, of course, today, but we have to note those levels. We have to note them. We have to take them into account. This is around 180.5 roughly. So that's another one that I'm looking at for perhaps a bit of exhaustion on those yen pairs. I'm not saying that the yen is going to reverse, because it's still a 0% interest rate currency, right? But in the meantime, you can't. Moves are not one way. Okay, moves are not one way. So we have to take into account the levels. We have to take into account when it starts to look a little bit exhaustive, and we may just be around that stage right now. So that is what I'm thinking on the yen. So it's still very tough to be long yen, because you pay a lot of funding straight away. But it's perhaps time to consider, when you're short yen, to at least take some of the table and take the pips and reassess the situation. Then a quick one, dollar peso stopped on those levels around here, those levels that I highlighted, 1710, 1707-ish, and we're stopping. Now we need to get back above 1735 though, to start creeping up again. So that's going to be our first resistance. But for the time being, 17 is holding. And a bit similar as with other pairs, it could be a little bit of exhaustion, you know. To keep a currency strengthening or weakening, you need the flows, and perhaps the flows have dried out a little bit after a period of extremely strong Mexican peso buying. So keep a close eye on what's happening around 17, low 17s, and then on these 17.25 again. If we start to move above these 17.25 again, then perhaps we have a chance of correcting more. I would still call it corrections though. Rand did not go and test my trend line here. I was hoping for it, and in the meantime, we are already building some support around 1815 and creeping back above this trend line here. We could have corrected enough. We'll have to monitor the next couple of days what's going to happen in the low 18s on the Rand, but this could be enough, and perhaps start to creep higher again. That's a bit of my feeling there. And that's it for me for today.
Thank you very much, mate.
And I wish you all a pleasant day, guys. Have a good one.
Thank you, mate. Speak to you later. Still, anything in particular tickling your fancy?
Not really, just one comment about metals yesterday, because Kay was asking. There was, as far as I could see, there was absolutely nothing that warranted that move. Yields were dropping, the dollar and the stocks were doing pretty much nothing. So it was pure play on stops, I think. And the main stop that we have is gold below 1930. And we're there again now. So I think markets are going to want to push all these buttons and try to take out as many longs as possible. And if you look at retail positioning, it's quite long metal, especially silver. So I think, as I wrote on Twitter and on the chat room yesterday, I think retail longs have to be taken out, or many of them have to be taken out before we can move higher again. So I still think it's a 50-50, maybe slightly better than 50-50, that we break lower and gold heads to 1840, 1850. Really, I think that's the next major support, in silver 22, low 22s. So I didn't see any reason for silver to be down 30%. Sorry, 30%, 3% yesterday. But that's what we have, and that's what the markets are trying to push. So it's looking very weak on the bounces. Risk accordingly.
Yeah, it's looking very weak on the bounces off of this 30 level, isn't it? At the moment, we had a few little mooches under, and yeah, the bounce, particularly in this move yesterday, isn't looking too hot. Can't even get back above 40s, which is just around these prior lows here. So yeah, definitely looking weak in gold. But if we can't get fresh lows, maybe there'll be a bit of relief for the sellers who have been pushing. They don't get what they want, and the buyers step in again and running back higher. But yeah, just starting to edge lower. The highs are just starting to edge lower, and the lows are starting to edge lower as well. So.
By the way, Ryan, I don't know if you're showing charts, but we can't see anything.
Oh, I'm not showing my charts, am I? So
yeah, it's okay. It's okay. I just want to add one more thing. Inventories, COMEX, LBMA, and all that, they're still dropping. So at some point, this is going to matter, because let's not forget, futures are linked to deliveries. And when the inventories fall at a low enough area where physical trades at a, in silver is like 30+% premium to where the futures price is, I think somebody's going to step in and try to take advantage of this ARB. So we have to be quite aware of that.
Yeah, definitely.
By the way, we cannot see your screen still. It says start the screen sharing, but we can't see it.
Oh, for Pete's sake.
It's the usual stuff, isn't it?
Let's try that again. How's that?
Same thing. It's still showing the black screen saying started screen sharing, but no screen. Anyway, it's okay. If you want me, if you want to show something on a chart, I can pull up a chart if you want, but I think we've covered a lot already. And
any good?
No.
No, right.
This is the system telling us to call it a day.
The switch from K. Yeah, I don't know if he took it over and didn't hand it off. Anyway, yeah. Well, I was showing. You can all look at your gold charts. You can see that there's a little bit of a downtrend coming in, at least since June. Lower highs and lower lows. So yeah, I think there's definitely a chance we break down in that one. We have got PAL today. It is what's known as Humphrey Hawkins, the semi-annual monetary policy report committee doodad thing in both houses, one today, one tomorrow. We've had the actual monetary policy report that he's going to be presenting. That came out on Friday. Those of you in the chat room can find that in the news and research room. We will be getting text of his testimony, probably dropping maybe an hour, half an hour before he actually speaks. So that will have the super nuts of what he's going to say. Largely, it's a repeat of the last FOMC, but it has been known that he throws in a few choice comments just to reinforce whatever stance they have. As I say, that might drop an hour or 30 minutes before his testimony starts today. And then we face 12 hours of grilling by politicians. So get the coffee on. That's coming up later on this afternoon anyway. And on that note, wish you all a great day. We're over the BOE hump. Well, over one BOE hump, the inflation report. Tomorrow, we've obviously got the announcement and whatever fun and games that brings. So we'll sit with bated breath for that one. Thanks, Phil. About that. And thanks, guys, girls, for coming to the Flow Show and all your support. We'll see you all tomorrow.
Thanks, Ryan.
Cheers, mate.